When putting together a strategy for investing in the markets and a portfolio, it's important to look at the risk aspect of that and the management of that risk. Let's take a look in some more detail now with Ron William from RW Advisory. Ron, welcome.
Thank you.
We've spoken before about the behavioural psychology of the approach to the investment world, and I know that this touches on that. Explain what we're looking at here in terms of the resilience and the risk management.
Well, risk management is key across the board, no matter what the strategy is. And in the economic finance world, risk is all about the risk to reward payoff, that mathematical equation that every trader and investor must abide by. But one of the key points I want to bring back in the latter part of our discussion is that this is a human physiological experience. So anyone who's actually having a poor risk management experience, good or bad actually, if you're actually making too much money or on the loss side, it can, of course, be excessive stress, take us into that survival state where stress response really starts to increase. That bottom right-hand image there just showing the lizard brain triggering off in that fight or flight reaction. So these are similar traits that other professionals in their high-intensity field experience, like athletes and also soldiers in battle. And it's no surprise that all these three areas share the same reactions because we all have the same biology.
Well, let's look at the traditional model and look at what we have to do when looking at this.
Yes, well, the work still has to be done. So that's why we begin here, really, before we progress on to the psychology or the biology of things. But essentially, there needs to be some kind of risk management check in place. And we don't know what we don't know, so the first step is actually to check on what that risk is. I think when you're starting out in the trading or financial industry, this is actually where everyone needs to focus a lot of their efforts. And some do, some don't. Essentially, identify the risk. And then once we've done that, impose some kind of a qualitative or quantitative limit, some real tight controls in there that can be monitored and followed up with on a regular basis. So often people do this in a trade plotter, trade by trade. They're looking at how much leverage they have, what their Sharpe ratio is, drawdown recovery rate. So if you're having a loss aversion moment, what's your bounce back factor? And then also exposure limits. How exposed are you to a region, country, single name, sector, particularly in the equity space? So all of these are important risk management questions that we should be asking.
But then, of course, times change. Over a period, of course, we either grow older, we look at different things, and the risk profile presumably has to change with that change in focus.
So this is the big problem with financial market theory, and I must kind of be frank on that point. It's based on the fact that risk and maybe behavioural traits do not change, or at least the old historical model does. And so we are since moving on with the times, recognising that behavioural attitudes change all the time, and so do their risk preferences. And so the first and most important point is they change with the seasons of the market, or the cycle. And so often during good times we take on excessive risk into that euphoric state, but at that point we're usually the last greater fall has taken that last penny off the road at the expense of a big crash. And then the opposite is true. When the crash has actually happened, the market's hated, pessimism's at its all-time extreme, but that's when opportunity is at its best. And so often it's at the extremes of this cycle that risk profile changes the most. Taking on too much risk at the top and really just avoiding the markets with a risk-averse attitude at the bottom. This is the roller coaster ride in the cycle. A lot of it feeds through to investor attitudes. So that last chart there at the bottom, investor types, where depending on their attitudes, their trader types, intuitive, exploring, strategic, realistic. These are kind of psychometric tests that people can take just to have a better understanding of their trader attitudes. But also it depends on their financial knowledge and their just emotional balance. So it does matter. So the more seasoned traders will tend to have better experience with managing the strategies and risk. Also, risk changes not only according to investor type, but also cultures and cross-asset risk profiles. So the bottom chart there just shows that in Western mature markets, where we've traded maybe a little bit longer with a little bit more developed structures in place, we tend to take on less risk, whereas potentially in the developing markets, and let's say as a case in point in the East, according to a Swiss-based behavioural think tank, this is their data, the Eastern markets or developing markets tend to take on more risk. So risk tolerance does change from region to region, and sometimes it depends on the mandate of the institution. And on the portfolio side, just think about your average day pension fund. Yeah. Obviously has much less risk on the book, or at least they should do, usually in the bond market, versus someone trading stocks, looking for a high reward and taking on that much more risk.
Let's introduce the next slide. I'm keen to do this because this does connect up with what we've spoken about before, the behavioural side of things, and how the mind works when looking at your risk management style.
Yes, so in a pure mind model, and we will progress on to how to connect the dots and look at a holistic model, but in a pure mind model, there is a one-size-fits-all for human nature, and that is that this idea of fear and greed rooted in the very fact that pain of loss is twice as great as the pleasure of an equal gain. Scientists have proved this time and time again. And the main reason behind that, or at least a neurological reason behind that, is that when we lose money, we go into that stressed survival state that lizard brain triggers. But the chemical that actually gets produced is cortisol. So we know that in our day-to-day health checks with the doctor. More stress, higher blood pressure, adrenal glands kind of overproduce and probably exhaust us. But also at the same time, cortisol levels get excessively too high. And this is chronic stress that we're talking about, not just watching a horror movie or going on a funfair ride. This is ongoing deep stuff. That usually switches off the thinking part of the brain, the neocortex, and then we make mistakes, and it's just a negative feedback loop. On the upside, if we're making money, the neurotransmitter is dopamine. That's, I think most people who go to the gym know that as the happy chemical. Yeah. We produce more when we're happy, but excessive dopamine is an addictive cycle, and that's what really breeds the greed, which we need to manage when we're actually in a winning position. And actually, most traders that unfortunately blow up or just lose more money than they should is after a winning streak. So a lot of people kind of think, well, it's only when I'm down in the market that this stuff matters. Actually, when you're up and you're excessively up for a winning streak, that's when you really need to be putting your controls in, at least on this level, and knowing that at some point in time, your biology, your physiology is actually going to take over, not even your psychology by itself, or even the strategy you're using.
Let's bring it all together and see how they all connect, because you've got a number of threads and strands out here that you're looking at. How do we bring it all together as a strategy that we can adopt?
We need to have an open model, and throughout my career I've always employed that just by nature, but also through practice. And it's very true, I think, also based on the Eastern culture. I've just flown in from Asia. In ancient times and still now, they very much view the world, but also the mind-body connection in this way. They don't separate in the Newtonian model way. They very much connect the dots and recognize it's a holistic system. Our mind speaks with our body and speaks with our heart emotion side. And this isn't just an abstract theory. All traders and investors should already know this, and if they don't, just be in a high-stress situation and you'll go through the experience. Now, the point here is recognize the ecology. Again, we don't know what we don't know, so we have to begin with awareness and understand it's an ecology. It's all speaking to each other. It's like an ecosystem, as you will. And there's lots of scientific results out there that are now showing the positive effects to resilience training. So anytime there's high volatility in the market, as it has been the case since 2018 up until now, and of course big crisis situations like the 2008 global financial crisis, stress goes up, and we need to know how to improve our resilience, just like athletes do. So the three insert charts I have here, first one showing that calming exercises are actually proven to better manage the lizard brain, the survival system there that triggers our fight or flight. The density can actually be reduced through just simple calming exercises. That could just be breath work, meditation, a good game of golf, or just quality time with the family, whatever it is that calms us down. The second chart there is just showing emotional balance. This is actually the number of heartbeats and the shape of the rhythm of our heartbeat. If we're reasonably balanced and happy, we've got this kind of coherent curve. It's got a harmonic pattern to it. Of course, the other one looks like a stock market crash. It's when we're upset or negative or just having maybe a loss aversion situation. Then it starts to create erratic heartbeats. Now you've got tech wear that you can wear that measures your heart rate, and you can. And a lot of people do this at the gym, but even traders do this at the desk. And last but not least, a great work from an ex-trader, now a university professor at Cambridge University, John Coates, has also proven that hormones are triggered during volatile times. And the bottom chart there shows stress hormones, cortisol especially, as we looked at the previous chart, rising and falling with market volatility.
Interesting. Okay, Ron, got to leave it there, but thanks indeed for joining us. Ron William from RW Advisory.